What is QSBS and how do we take advantage of it?
QSBS is a tax regulation to incentivize investment, particularly investment in tech startups. Venture capitalists love QSBS. If you get shares from the company, which founders do when they form the company, and which investors do when you do a equity financing in a company, and you hold those shares for 5 years. If the company is worth less than $50 million dollars or has gross assets, of less than $50 million dollars at the time you receive the shares, then you could potentially get QSBS tax treatment on the sale of shares in the future, which means you can pay zero tax on up to a certain amount of the shares that you're selling. So for most founders, that tends to be up to around $10 million. It can also be up to 10 times your tax basis in the shares that you buy. Founders' tax basis is very low. It tends to be par value. Investors, however, let's say you're a VC investor and you invest $10 million in a company at a $30 million valuation or whatever it might be, but let's keep it below that 50 million in gross assets number, then you might be able to get your first $100 million in proceeds tax-free, which is why it's massive. And in every financing, you'll see representations and warranties that companies will need to say, hey, we've checked with attorneys and we're pretty sure that we're QSBS eligible. A lot of times there's a covenant that investors will ask for, that you will do everything commercially reasonable in your power to keep QSBS eligibility. And as you can imagine, because of the benefit, it's something that's very important for investors. And it's something that we as attorneys work with our clients to make sure that you're not tripping up on anything along the way that might make you lose this benefit, because it could significantly affect your valuation based on how investors are looking at your company.